This is Benzinga Live. Spencer Israel and producer AB.
What's up, everybody? How we doing?
Someone told me buy high, sell higher.
Let's get Matt Hammond on the show to talk some IPOs. Jake Wojacek from Trend Spider. We have a
breaking news. What is up, everybody? Welcome back to another episode of Benzinga Live. Happy Tuesday, but more importantly, happy Powell Day. Mr. Jerome Powell will take the podium here in about an hour and 8 minutes, 12 p.m. or 12:40 p.m. Eastern. He's going to speak at the Economic Club of Washington. I don't know. So the original plan was for me to go boots on the ground, reporting from the actual speech and maybe even like just interrupt Powell and ask him shout out some questions to him. I don't know if I'm gonna be able to get from here from the show to there in time. So as a kind of what we're gonna do instead is we'll be pulling the stream up any way we can, pulling up if not the stream, live quotes from the stream, kind of giving our reaction from it, seeing what Powell is saying. We've seen some crazy moves basically every single time Powell's spoken the past 6 months or so. I mean, ever since inflation has really taken off. Powell's speeches have been just huge market catalysts. So we'll watch how the market's responding kind of ahead of that. Before we bring our first guest on, who I see hanging out backstage, very excited to bring on Jacob Gabbard. We're going to be talking about Elliott wave theory and some other cool technical stuff that we don't typically get to on the show, so I'm excited about that. But before we get to that, let's just do a quick rundown of the overall market, see how we're trading right now, see what we're looking at today. Your S&P 500. Well, not really your S&P 500, but your SPY, your index from Spider that tracks the S&P 500, is up about almost 0.2%, 1.17%. So pretty flat, relatively flat. A lot of investors out there just kind of chilling until Powell speaks. They want to, they want some confidence in Powell of whether he's going to say, "Look, we're staying course." All right, so here let's go through the overall market real quick. Qs up. So tech leading today. You can see Dow actually in the red, SPY. So this is typically what you see on a day where tech is leading. Qs in the green, Dow slightly in the red, but SPY. So what I'm curious here is let's look at the energy markets like XLF. See how that's trading today. See what's what in the Dow. Okay, so energy is actually doing okay. Financials are doing okay, so I wonder what in the Dow's not doing well to bring that in the red. Albeit it's pretty flat. And even though NASDAQ or the Qs are leading the indices, it's interesting to see ARK in the red, so it's not like crazy growth is leading today. So I bet you it's, your Metas, your Googles, so not the huge growthy companies, but the big major tech companies seem to all be having a pretty solid day today. Apple, Amazon, or actually Amazon's not doing well, but Meta, Apple, all doing well today. Google up 2.5%. So that's why our Qs are up. But yeah, I mean, it seems like people are pretty just chillaxed, waiting for Powell to come out, see what he has to say. So here's what investors are looking for. So Powell has acknowledged that inflation has come down, right? Starting to normalize a little bit, saying we've made progress. He also acknowledged what was this last week at his last FOMC? Yeah, it was last Wednesday, I believe. Basically, for a while, and I harped on Powell on this and gave him and the Fed a tough time because my biggest problem wasn't with the how the Fed was raising rates or whatever. It was just how basically Powell was talking, his tone essentially, where he would say things like, we need to see pain in the labor markets, we need to, et cetera, like essentially in the past few months, Powell had been talking as if a soft landing off the table, we got to raise rates up to essentially engineer a recession, or maybe not recession, but at least make it to where unemployment starts creeping up, there's pain in the labor market, that will help inflation. That was Powell's message basically a few months ago when the market was getting crushed. Fast forward a couple months, inflation has come down. Unemployment numbers have actually been great. The labor market's been incredibly strong. And when Powell spoke last week, basically said a soft landing is somewhat back on the table. It could be possible now. Something that a lot of economists, if you would have asked a lot of investors, a lot of economists 2-3 months ago, hey, what if I told you that inflation was going to come down 3 months in a row, month over month, and unemployment was going to go down? They would have they would have kicked you out the door. They would have said, "I don't believe it." You know, I don't want to. I don't want to even know what drugs you're on, because that just doesn't happen. That doesn't happen. And economic textbooks would tell you that's not possible, right? You would need to have unemployment to come up. So anyway, I have no clue what Powell's going to say today. He's just talking at the Economic Club of Washington, so it's not going to be as serious or regimented as some of his other speeches, but it is going to be, people are going to ask him questions. He's going to give some insights. Here's my expectation. Is that, while yes, Powell, again, will probably acknowledge that we've made significant progress on inflation, etc., he's not going to want to sound too dovish. He's not going to want people to get too excited right now. He doesn't, in my opinion, Powell's probably sitting in a position where he's like, we're close. We've made progress. We're close. I can see the light at the end of the tunnel. He doesn't want to do or say anything right now that is going to put us back in the woods, that is going to, SPY go up 5%. Next thing you know, inflation's picking back. All these things. I think he'd rather say, hey, look, we're going to stay course, until inflation gets closer to that 2%. Even if we're looking at 4% right now, year over year, whatever it is, 4.55, and it's a lot better than 9%, it's still not great. We still want to be down to 2%. So that's just, again, that's just my opinion, what I'm expecting him to kind of, if I had to pick leaning dovish or hawkish, I'd assume he sounds more hawkish still. And again, I think part of that is just a type of jawboning, him not wanting the markets to get ahead of themselves, him, wanting to see what we've seen continue. But, I think there's a lot of people out there that are long, looking to get long, and that if he says one little thing that people interpret as super bullish, you could see the market take off, and the opposite is true as well. I mean, he could say all pretty good things and then just say one thing about, maybe that because of the great labor numbers, that now the expectation is we can keep rates higher for longer is what a lot of people are calling for, right? Higher for longer, right? There's a flip side to the economy being so strong or holding up over the past few months, and the flip side to that is that the Fed has ammo in the it has the ammo in the clip now, essentially, to keep raising rates or to keep them high, to say, what do you mean? We don't need to bring them down, right? A lot of investors were saying that, by now the Fed would have to start looking at cutting because unemployment was going to start going up. And you had, who was it? Credit Suisse and these banks that were about to break, and the cracks were forming and all this. And that hasn't been the case at all. That hasn't been the case at all. So we'll get back to Powell. We're about an hour out. We'll do another preview as we get closer, but I did just go on for too long. I've got our first guest hanging out backstage. So without further ado, let's go ahead and give Mr. Jacob Gabbard our very special Zinger Nation welcome for his first time on the show. Let's roll that intro. When we come back, we'll be talking some EWT, Elliott wave theory for the uninitiated. Mr. Gabbard, how are you doing today?
I am awesome, Aaron. How are you?
Good. Thank you for asking. So your first time on Benzinga Live. Before we get into Elliott wave theory and the charts and everything, tell us just a little bit about who you are, what you do, and how long you've been in the markets for.
Yeah. So first, thank you very much for having me on. I appreciate it. And I've been investing. Sorry, I might get emotional here. My dad's in kind of a bad way, but he's the one who brought me into investing. And he used to give us P&G stocks when we were kids. And, that was back in the days when P&G was in its heyday and it would split about every 3 years. And I was just fascinated by that idea. And from there, through trial and error, I lost a whole bunch of money in the stock market. And then, really got down and studied and became a student of the game, and then got into Elliott wave theory, which I think is the single best way to not necessarily predict, but understand the sentiment of the stock market, driven by fear and greed, and how we can measure those things and understand targets as we move forward.
Got it. Yeah, not to get too sentimental, but I understand, because my late father was the one who sparked my interest in the markets, as well, among other things, and so I know it's difficult sometimes. But yeah, so Jacob, I'm curious because I have a lot of different traders on the show that use different technicals that and what essentially drew you to Elliott wave theory from the vast, thousands of different strategies and ways that people, look at charts and do technical analysis?
I read an article by a guy named Avi Gilbert a long time ago, and he's kind of the head honcho in this field, and he kept making calls that were amazing. And this was quite a while back. And so I started studying it and finding out what was going on, how he was able to understand the market the way he was. And I just kept finding that over and over again, you could put together solid targets for where the market was expected to go, where you could find tops and bottoms, support and resistance, and all those things that are so important to trading. And then I even went further to that and read books on investing with it and how to use it. Everybody says, oh, well, every video you do has two paths. Well, yeah, but the market has infinite paths, and we're narrowing it down to two, and we're trading the most prominent one. So the idea that you can understand where the key levels are when the market switches its opinion and how to pivot that trade and be profitable doing that is just fascinating to me, where a lot of people use dry indicators that are nice, but don't necessarily have the same predictive value as Elliott wave.
Got it. And I mean, what would be, I guess, like if you were trying to teach someone Elliott wave theory for the first time? I know it's probably, not something you can do in 5-10 minutes, but kind of like where would you start? And I see, or if you've got any visuals, charts, anything you want to pull up, by all means, please do so.
Yeah. So first, we don't need a chart for this part, because Elliott wave theory is essentially measuring real-time market sentiment. A lot of people like to try to rationalize the market with the news or the Fed or government moves, things like that. And the market is not a rational entity. To me, it's an emotional entity. It's driven by fear and greed. And if you've ever tried to reason with anyone who's emotional, they do things that are way out of character. For instance, we get a hot CPI number and the market shoots straight up. We get, the Fed the other day saying they're going to raise rates and continue to raise rates and continue to lower their balance sheet, and the market rockets higher. That's not rational. But the emotional side of the market says, this is how we do things, and it becomes a way to understand sentiment, which is really what moves the market. News, I tell my guys all the time, is just noise, and all it is a catalyst to allow the market to do what it was already going to do. And so that kind of idea and mindset is the very first thing you have to understand if you truly want to do Elliott wave.
Got it. So I see some good questions in the chat. Someone's asking, which books would you suggest?
You got to start with Elliott wave principle. It's kind of the baseline Elliott wave book. And then from there's a very good one called Investing with Elliott Wave. And that one is very solid on understanding where and how to place entry points when the market's doing what it's doing, and then where your stop loss needs to be. Because in a lot of cases, you're looking at, if the market does what you expect, a 7 to 10% move in the market, where you can set a 2% stop loss, so you're getting 3 to 5 to 1 on your trade. And those are the kinds of risk rewards we're looking for when we make trades. We also use hedges very well, and use all of those types of things to capitalize on market movements.
Got it. So I see Tim in the chat saying you're a master options trader. So Jacob, I'm curious, do you find that Elliott wave theory helps specifically in any types of options trades, or is it just gives you a good setup, and whether you were going long common stock or going long options, it's the same, you just choose to do options for whatever reason?
Yeah, you can do it either way. If you choose to do options, you got to be very aware of expiration dates and theta and things like that, because like we're seeing today, you can get a lot of chop on a given day waiting for the Fed for the catalyst of the day. You can even get that a whole week, if we got a Fed meeting on Wednesday. So you got to be educated on where your expirations need to be, how your theta is going to work with that, and then ultimately what kind of target you're using, and then what kind of hedge you're using. We never leave ourselves out to dry. We always either have a stop loss on a day trade or a hedge on a swing trade, and that allows us to really take advantage of eliminating emotion, I guess is the best way to say it. So many traders get caught up in emotion when the market moves swiftly in one direction, and when we are able to hedge productively and cheaply against our core position, it allows us to take emotion out of trading and allow the trade to play out, so we can grab full value on that trade.
Got it. Yeah. And I mean, I'm just curious about that, because I like to trade options myself, and I've never, I know some people that have kind of specific technicals they use for options trades. But to me, it's like I'd rather like, it seems like it should be the same, right? You should be able to look at a chart and determine if you think it's going up or down, and if you do think it's going up or down, by how much and by when. And if you do all that, then it shouldn't make much of a difference if you do options or common stock. So, Jacob, something I'm curious about, because you're talking about how Elliott wave theory is really a look into kind of real-time sentiment and everything. Are there any times where you think that Elliott wave theory kind of falls short, or times where it's like, okay, maybe it's not the best, maybe like extreme volatility, like during the COVID market crash or stuff like that? Are there any times where you're like, okay, this isn't really working that well?
Yeah, so there's no indicator that's perfect, right? There's no magic indicator where we'd all be billionaires. So everything has its pros and its cons. For me, the biggest negative to Elliott wave theory is in the micro counts. It is fabulous at the macro counts, so at predicting bigger targets and understanding where the market is heading over time. It is unbeatable in my opinion. But when you get down into the day-to-day minutia of the market and the chop and the overlap and all the things that go on there, it does have its in that part of the market. And but to give you an example of predicting, so last October, well, you can go look at the video on 10/12/22, we were coming down into 3,500, and I said we should be bottoming here, and then once we do, we should be heading to 4,300 based on the Elliott wave patterns that were playing out. And I was just told not so subtly that I was an idiot and laughed at, and now here we are breaking 4,200 at the target we predicted for the first move up, and we're still expecting to see that 4,300 over the next couple weeks or so.
Wow. So Jacob, I mean, in terms of the current market environment, we're kind of, I mean, the way I see it, as this kind of not turning point's not the right word, but this, I guess, kind of pivotal moment, right? Where it's like, a lot of people are thinking we're about to take this next huge leg down. Some people are thinking, all right, we're just getting started. Do you have any sort of like directional sense on how you feel about the market? Do you lean bullish or bearish right now?
Yeah, actually, this would be a point. If you want me to pull up my chart, I can real quick and kind of show you what we're looking at.
If you have any trouble with that present tab, just let me know, and we'll try to work it out. It should be pretty easy though, hopefully. Knock on wood.
Okay. Can you see my chart now?
Yes, sir. Popping it up.
Okay. So back here, let me pull this up just a little bit. I'm on the hourly chart. So back here when we bottomed around that 3,500 level, this is the futures, by the way, for people who are worrying about the levels. So we considered that a big wave 5 down of a bigger wave A. And what we're essentially seeing from the January top in 2022 is that that was what we call super cycle 3, and we could be in a super cycle 4 at this time. There's a couple key points. We're at a very pivotal point in the market at this moment where we'll kind of figure that out. But off of this, okay, we consider a wave, and Elliott on corrective pattern works in ABCs. You can see them all over the chart here. You got an ABC. And so what we were looking for here is a bigger, okay, A, B, C to play out for a B wave up toward 43 to 4,400. And you can see we started calling this back here. We traded it up. And what we're looking for is still a little bit of a pullback and then a push higher up here towards 4,300. And ultimately, if they play it all the way out, we're looking for this B wave to complete somewhere in the 4,400 range. Not directly, not straight up. It does move in waves. That's why it's called Elliott wave theory. So from here, you'd look for a pullback in wave 4 and then wave 5 up. Like that. So once we get to this B wave point, C waves, especially of this magnitude, are really big selling waves. And the C wave typically equals about the length of wave A. Well, wave A came down about 1,600 points. We're looking for that same kind of drop here into the 29 to 2,500 range on the S&P 500 as a sell-off that really crushes a lot of 401ks and people's bankrolls because they're just not expecting it. We're looking for a really nasty sell-off at that time. So many people were calling for it back here, but the problem was you only had your A wave, you needed a B wave. And this is all about market dynamics to me. You have to have buyers for sellers to be able to sell. Well, once you sell the market down so far, you can't sell into anybody else because nobody's buying the market. So what they do is they give you a bullish B wave up, which is a trap. Okay, this gets buyers involved. This gets everybody bullish again. This gets everybody talking about all-time highs, and then they pull the rug out and sell into all those buyers, and that's when you see these really vicious falls, like you saw in like 2008 and things like that. So I do think that the primary path does have us pointing lower into the 2000s, but there is a small outside chance for a new all-time high. It will depend on what happens.
Wait,
If
2000 on the S&P?
Yes.
That's what, more than a 50% decline from here?
I was laughed at when I said that the COVID lows could go back to new all-time highs. I was laughed at back here when I said that we should be
I'm
going
not
to
laughing. I'm
43
just trying to
here.
understand. I just want to make sure
No,
because this is a busy chart, and for me, I'm not that smart, so I like to, like when I bet on a football game on the over, I have like one number I'm rooting for, right? 47.5 points. Just give me a number I'm rooting for because I can't follow all this, so I'm rooting to either get above where you're at right now, 4,300.
Right.
All right, that's
And
my
so-
number, 4,300. That's what I'm rooting for. If we can't get above that, then I'll join Team Bear with you, and we'll be rooting for 2,000. I don't know.
Now we could hit 4396 as the actual top of this B wave channel that we would be looking for. It doesn't have to play out, and at 4,300, I would be extraordinarily cautious for that sell-off that we could see. But yeah, we are still looking for at least one more push higher towards 4,300, and ideally 2 to 44 or so.
Does it kind of not scary, but I guess if you're betting on the, if you're taking like short positions and like, to me, I always like to see where the sentiment's at, and like where it kind of spooks me, I think, going short right now, just the fact that it seems like everyone's calling for this huge market crash. If I'm thinking, if everyone's saying the market's about to crash, if everyone's saying, we're about to go back to new, it makes me like less believable that it's going to happen.
Right, and that's why we still have legs higher here, not necessarily because everybody's saying something else, but because the pattern calls for it, and that's why people get in early. Emotion, like I said, this is an emotional market. That's what a market does, is it drives emotion, which drives mistakes in people's trading, and we try to eliminate that by understanding where the key levels are. So if this doesn't go to 4,300, we understand that our next level down is around 4,000 that we would look for support. So we understand key levels. If 4,000 breaks, then we might already be in that sell-off. So we kind of have to take it leg by leg and step by step. We're not trying to trade a year out most of the time. We're trying to trade, weeks or months out. And we started buying this wave 3 up down here at the bottom because we have a measurable target at the 1,236. And we started buying here with some hedges. Once we cleared out and got the setup we were looking for, we let go of the hedges and did very well on that trade. So just understanding key levels is really what's important in the market, regardless of any indicator that you use or any style that you use. You have to understand where support breaks, the market breaks, or resistance breaks, the market shoots.
Yeah, and that's where I think we're kind of at this precipice or like pivotal point right now, where there's, I still think a lot of, it's not even I think, like there's a lot of money still on the sidelines from, if you look at like how much money was in the total equity markets from, institutional investors, big banks, et cetera, a couple years ago at the, peak in 2021 or 2022. And I don't know if a lot of these guys are like ready to get long yet, because I think the bigger macroeconomic climate is still a little bit cloudy. It's just not exactly clear. I think even if it were more negative but clear, right, that we were like heading toward a recession, like maybe that would give those investors more confidence to invest, because then they'd know, okay, at least we know we're like going to a recession. The Fed's gonna have to cut rates, right? They don't know. Like the Fed could keep raising for the next year, or they could be cutting 6 months from now. And I think because of all that uncertainty, just you have a lot of banks and institutional investors kind of still cautious and whatnot. So, very, very interesting time, I think, to whether you're looking at the fundamentals, whether you're looking at the technicals or the charts, because I talk about this a lot too. It's always funny and interesting how it always just seems like, I guess by happenstance, randomly, by coincidence, that like you'll be at this huge, say fundamental catalyst, like Powell speaking, and where no one knows what the next thing's going to be, and then the chart's also at this like very pivotal time. It's like, oh, of course, they work out like that.
Yeah, absolutely. And that's a big reason I turn off the TV and don't listen to it. I won't watch Powell today. I didn't watch him last Wednesday. I just watch the levels, and when the levels break, we adjust.
Yes, sir. Well, I think that's the best way to do it when you're watching charts, is to just kind of take the noise away and then look at the info that you have.
Yeah, it just creates too much emotional response, which makes mistakes in trading.
Got it. All right, well, Jacob, this has been awesome to get you on the show. Always like talking some Elliott Wave and some technicals. Where can folks find more from you? I know we've got some of your folks in the chat here from Discord or from wherever, but where for those who aren't already in there if they want to find more from you?
Yeah, you can go to investwithjacob.com. And we have a daily video update on there every day, as well as my YouTube channel, also Invest with Jacob. And we have a daily update on there as well, where we kind of give a macro update or a micro update, just depending on where we are in the chart.
Awesome. There we go. We got the link in the chat, investwithjacob.com. Jacob Gabbard, thank you again for hopping on Benzinga Live today. Hope to have you on again in the future.
That would be awesome. This was awesome. I really appreciate it. Thank you very much.
Yeah, you too. Have a great day.
Yep.
All righty, y'all. That was Jacob Gabbard from investwithjacob.com. If you want to go check out more from him, like I said, we don't get enough Elliott Wave on this show. We don't get enough love for that, so we got to start doing that some more. Before we get to our next guest, let's just do another quick rundown on the overall market. See what's going on there. I don't know. I haven't checked since we've started the show. But let's check real quick. We've got Google. Hold on. Google's still up. All right, that's good news. It's a good way to start. SPY. All right, so it looks like we haven't had that much movement since we've started this show. Everything is pretty much the same. Dow is still slightly in the red. Qs are still leading the day, and your SPY is still in the green, albeit very slightly, up about 0.1% right now. Looking at the 5-minute chart here, we can see a little bit off the high of days, but hey, we're getting close now. 42 minutes away from a man, Powell, speaking, so we shall see. But alrighty, y'all. I got my next guest here. We've got a special surprise, an in-person guest. Let's go ahead and roll our special guest intro when we come back. I'll be back with my man, Jason Brown. Without further ado, let's give him that special guest intro. All right, live in downtown Detroit with my man Jason Brown. Jason, how you doing today?
Fantastic, man. Glad to be back in the building.
Good to have you back. Good to have you back on Benzinga Live. So a lot's been going on since the last time we've spoken. I'm gonna go ahead and just pull up a chart here. I mean, well, actually, before we get to the stock market, what have you been up to? What's new with you?
You know, we just got back from Florida. Took the family down there for a little family vacation, and I actually closed out some all 8,000 of my shares at Amazon last week, so I'm feeling pretty good.
Okay, so are you closing out your shares at Amazon just because you wanted some extra cash in your pocket, or you wanted to you think we're about to maybe move lower?
I'm looking at the narrative of the market, and we got what we needed to go higher. We don't have what we need to go even higher. So I said, my motto is you never go broke taking a profit. So it's always good to ring that cash register, bring the troops home. I look at trading like war. Every time you send them out, it's a good chance your troops could die or not come back home. So any day you can come back home and capture some green soldiers with you, it's a good day.
I've never thought about it that way, but I might be visualizing that next time I throw out an options trade. Be like, do I really want to send those 500 soldiers out there just to get? That seems like a suicide mission. Buying these out of the money calls.
Exactly. If more people thought about it like that, they would think twice before they play some of the trades they place.
Yeah. So you missed the whole big snow and everything while you were down in Florida?
I didn't miss the big snow, but I missed the cold front.
Okay.
So I missed the cold front. Yeah. And now we back. We got like 40, and it's going to be 50 next week.
What part were you in? Like Miami, Fort Lauderdale?
Panama City.
Okay, Panama City.
Yeah, right. Took the kids down to see their grandparents, and it was a good time. Good getaway.
Awesome. All right, man. Well, like I said, it's been I can't remember exactly when we had you on last, but these markets are always crazy, always moving. We've I'll pull up just the let me get the daily chart here on my SPY real quick, and you can just look at. I mean.
Oh yeah, I got it up over here too.
We were what, down to just a few months ago in October. It feels like a long time ago, but that was only 3-4 months ago. We were down at like 3,500 on the S&P.
Mm-hmm.
Now we're looking a little bit better market wise, but a lot of people, like I had just mentioned before you came on, are still thinking we're about to take this next leg lower. Where are you standing right now?
I think we take a leg lower based on number one, the technicals, and two, the story that's in the marketplace. If you think about the technicals, for example, we're done going down and we've moved into what I like to call a sideways trend. I mean, technically it's a sideways trend, not what I like to call it, but one of my favorite trends, one of the three most profitable patterns. And so in order to go higher, you need a period of consolidation. So we're in a period of consolidation, but we're at the top range of that consolidation with no real reason to break out. And so when you look at the story around why I believe we're going to go lower is you got companies laying people off. That's number one. You also have slower growth. So people getting laid off doesn't encourage people to spend their money because they don't know if they're next. The other thing you got to think about is even though people get laid off, there's a ton of job openings. You don't get fired one day or laid off and then get a job tomorrow. I mean, you got to interview. You maybe take some time to realize what just happened. You got to get screened. And then who's to say you get another job making the exact same amount of money that you made before? So those two things are not necessarily good for the economy. Then you got higher interest rates. And then you got, like I said, more people holding on to their cash. So companies' profits are lower. So they're looking to cut costs, which means they're looking to not hire and not spend as much, which doesn't paint a picture for let's go to the moon with the stocks. So those reasons I believe we're going lower, but I don't think we're going to crash. I think we're going to oscillate or channel in between this range because life isn't as bad as when the world was closed during the pandemic either.
Right. And I think I'm with you a lot there with what you said. I could kind of play devil's advocate on a few of the things you said, but I really agree with the sense that so right now with where the interest rates are at and with how relatively well the labor market and the economy has held up, a lot of people are thinking now the Fed can keep rates this high for longer, at least until inflation comes down. Whereas in the past, a lot of a few months ago, people thought the Fed may be forced to cutting rates. Just because the Fed has to keep interest rates at 4.5%, 5% or whatever for a few months longer than some people think, that doesn't scream to me like huge 07, 08 crash.
No.
To me, that might mean, okay, we might see some like muted returns. Like you said, we're not like off to the races, off to the moon, but we can be reasonable about it and say like, okay, we think, SPY's not going to be going back up here to 480 or to be making new all-time highs anytime soon, but we also don't necessarily think it's going to be look like this where the COVID crash happened just straight down.
Exactly. And then you got to think, in order for us to get back up to the all-time highs, you had low interest rates, you had stimulus, you had foreclosures that were shut down, that you couldn't lose your house or get put out of your apartment. You also had delayed student loans. So we also don't have that picture to take us way back up to the top, but we also don't have the world shut down to take us way back down to the bottom either. So I think we channel for a while. And if you're a trader, that's actually good news because we like predictable, repeatable patterns. And so if we can find a predictable, repeatable pattern, which is sideways channeling, we got an opportunity to make some money.
Got it. So Jason, you mentioned Amazon. I'll pull up Amazon's chart real quick here.
Yep.
Are you seeing any charts of individual names that you really like, that you really dislike, thinking like, okay, this could be a short?
So Amazon is it's a little bit of a tougher chart because you see when it ran up, if you had moving averages on it, it ran up to the 200-day moving average. When you look at that, the last two times it's ran up to the 200-day moving average, it has been rejected. So if you throw those on there, I'll give you some time. You can see it's gotten rejected. So if you look, it's most likely coming back down, which is why I cashed out, because I think I could get back in at a lower price. The good news about Amazon is it's not going to zero. And so that's why I like it. That's why I'm able to buy high conviction, 8,000 shares, stuff like that, because I also know it has a built-in floor, a built-in safety net, because it's not going to zero. But when I was buying, I bought my first lot around 82, 83. I bought the second lot around 95 or 93 bucks. What I like about the $82, $83 level is that's where it was at. That is the COVID low. If you go back to when COVID hit and the world was closed, that is the COVID low. I refuse to believe that Amazon is worse with the world open with higher interest rates than with the world closed and we didn't know what was going on. And so anywhere down in the 80s, I like the stock.
Yeah, I mean, I think, I guess the only flip side to that would be, I guess when the world shut down, there were a lot of people that started buying stuff on Amazon that they wouldn't have normally bought on Amazon because they couldn't leave their house. But I agree with you overall that I think a open, booming economy benefits Amazon more than a closed, shut down one does. You just then have to decide, okay, do I think, knowing that, what about the impact of then the interest rates and the stimulus then and all that and figuring out where it is. But I agree with you. I mean, like, if this thing gets what would this thing get down to?
But I'm saying if you look at 82, I'm saying that is before people started shopping. That is when the world was closed.
Okay.
If you go back to last time it was at 82, that was the world closed, borders are shut, we don't know what's going on. And then people start shopping online and ran up. So I'm saying I refuse to believe around 82 that it's worse than when the world was closed and we didn't know what was going on. So I like it down in the 80s. I think that's the floor for the stock.
Yeah, no, I agree with that because I mean there were a lot of stocks that I think got down. I mean Disney is another example where it's like I remember when Disney got down to this COVID low, $80. Right, so Disney went from about 140, crashed down to 80, and then the stock ran all the way up to 200. Right when Disney Plus was going crazy and the whole market was going crazy. And I remember sitting there looking at the chart, thinking, "What was I doing not buying Disney at $80? Right? It's freaking Disney. It's not going anywhere. You think Mickey Mouse is going anywhere? You think Disney World's going anywhere? You think Disneyland's going anywhere? No, of course not. It's not going anywhere. And so it was like a no-brainer to buy it at 80, and then." Flash forward 18 months later, year and a half later, it got back down there. But then when it got back down a second time, I was like, I don't know. I don't know if I really want it this time. But now that it's come back up, I'm like, what about 80 again? That's all I had to do was buy Disney at 80. It was right there for me the whole time. It's that easy.
I mean, you look at it, that's a 34-point rally from where it just recently hit about 85, and now it's at 109. That's a 35-point rally.
Yeah. I mean, all right, so... Just someone remind me. If this gets back down to 80 a third time, I'm not making my mistake a third time. I'll buy it the third time at $80. I promise. I don't care what the macro outlook is like.
You better get some money ready because you can say the same thing about Apple too.
Right.
I mean, if you look at Apple back down when it hit 124. I mean,
although Apple's chart to me doesn't look that great. Like it's kind of okay. So tell me if you can see what I'm seeing, kind of. But looking at Apple's chart here, the way I have it pulled up, just on the daily chart, kind of this some consolidation up here, just kind of trading sideways. It reminds me, somewhat at least, of Amazon's chart before it moved down a bunch, like up here somewhere. You know what I'm saying?
Yes, but if you look around the 125 level and you zoom out, you'll see multiple touches of that point to where it's a pretty solid support. And you got to remember, companies still have real business. I think sometimes fundamentalists forget about the technicals, and I think sometimes technical traders forget about the fundamentals. Apple still has a core business, meaning people, even if they don't sell as many iPhones, you're buying apps, you're subscribed to iTunes, you're buying music, you're buying movies. And so there's built-in floors to a lot of these companies that they're not going to zero. So if you can not buy at the all-time highs, but buy where you realize, like, okay, in order for this to go much lower, it'd have to get cut in half again. That's like ridiculous. That would mean they lost half their business. Someone created a better phone. Someone built a better music system. And it's just not happening, at least not overnight or in 30 days.
Right.
And so you can feel confident grabbing some of these companies at some of these ridiculously low prices.
That's what I think is kind of crazy about the stock market, is just how it seems obvious in hindsight a lot of the times, but how overreactive the market is. I mean, you take something like Netflix, for example. Like Netflix, remember, in the last 18 months, couple of years, like in just 2-3 quarters of not so great earnings reports. And again, it's not like they came on their earnings reports and said like, yeah, our business is in trouble or going out of business. All they said was like, oh, our subscribers weren't as good last quarter as they were the quarter before. And like you said, people just forgot they have a business. Stock went down 80%, and people started saying like, oh wait, this company makes how many $1 billion a quarter?
Exactly.
Oh, this okay, like now we can start. So like if Apple says, oh, iPhone sales were down 3% last quarter, and the stock and the company loses billions of dollars in market cap, like that's essentially the market saying they expect that trend to continue, that they expect Apple to continue to struggle. Whereas I'd say I don't know. People seem to really like iPhones. People seem to really like AirPods. People seem to really like
Macs.
MacBooks. I bet that like next quarter, maybe, or if not next quarter, the quarter after that, people start buying more again. You know, so it's like I think you that's a great point that we got to realize on some of these stock on some of the chart moves and some of the moves that the stocks make. Like trying to think about the actual, because if you would have looked at Netflix's stock down 80%, and then you would have looked at the business and you would have said, okay, the business is struggling a little bit, maybe it's down 3%. That's not 80%, right?
That's not 80%.
That's not 80%, right?
Right.
And I know it went up. Netflix got to, it had no business probably being a $720 stock ever, and there were a lot of stocks that got overpriced. So that's when that becomes probably a little bit harder, is when you do get overvalued, because then it becomes harder to say like, all right, well, Netflix should be trading around 350 and it's trading at 700, whatever. So obviously it's not easy to like value these stocks and give them a fair price tag, but just because I'm good at it or not good at it doesn't mean I don't think the market's good at it either.
No, it's not. Well, the market isn't pricing rationality. They're pricing emotion, fear, greed, all these other things. And so that comes into play and pushes the price way down ridiculous. I mean, look at Tesla. I was telling people, Tesla down at $100. We are acting as if we just said, forget electric cars. We don't care about them anymore. And we're going back to gasoline. Like, come on. We haven't realized that he hasn't launched the 18-wheeler yet. He hasn't launched a sports car yet. I mean, this guy could venture into electric motorcycles, electric boats. I mean, there's so much that they can do. And all of a sudden he buys a company and he's distracted. The company's over. It's going to zero. It's like, really? Same guy that built SpaceX, Tesla, PayPal. All right, come on. And we don't give people enough credit, which is interesting.
Yeah, I mean, I think like anything else, people get on their sides in the stock market, right? And for whatever reason, Tesla is one of those super polarizing stocks where people either love it or hate it. People either love or hate Elon. I've been very critical of him and the company on the show, but like the whole time being like, but I'm a shareholder, you know what I'm saying? So it's like
Yeah.
People I don't understand why we can't do more of that. Why I can't say like I'm an Apple shareholder, but I wish Apple would do X, Y, and Z. And you have people out there saying like, why are you spreading FUD? It's like, I'm not spreading FUD. I'm just an investor, and I want to see my company like do the shit that I want to do well, do what I want to see them do.
Exactly. Owning some shares gives you a right to have an opinion anyway.
Yeah. All right. Well, Jason, any other individual names we should hit on?
Yeah, I think people should take a look at Target. It's one of those prime stocks that are in a channeling pattern. When you look at Target, you compare it to its only competitor, which is Walmart. I look at this as the best buy of the industry, right? There's no other real electronic store to go get things from. Same thing with Target. There's no real other place to go get toothpaste, deodorant, back to school clothes, groceries, other than Walmart. You only have the two big ones. And so they have an inherent built-in floor. Unless we stop wearing clothes, stop brushing our teeth, stop wearing deodorant, I don't see those things happening. And so you can see the stock is channeling between 140 up to 173, back down around the 140 area. So when you say, can you buy puts? You could, but rather than buy puts right here until we confirm that the market's going down, I think you set an alert and be prepared if it comes down to the 150, 145 area. You own a solid company that's not going to zero and that most likely will not be cut in half again.
Yeah, I mean, so here's what's interesting to me about Target and something that I've noticed over the past, I guess, like year or so is as the market turned over, a lot, and when real recession fears were like bringing the market down, people were worried, okay, like we're heading toward a recession because we're going to have to keep interest rates super high to bring inflation down or whatever. I noticed a few different pairs of companies like that, like take Target and Walmart, for example, that the Walmart, whatever like the cheaper one of the two, held up a lot better, right? There'd be like the luxury option and then like the cheap option, and like the cheap option, whatever that name was, held up. So I don't know if that was the market just thinking like, okay, maybe people that shopped at Target are going to have to go to Walmart because shit's getting a little bit more expensive or like whatever it is. But now that that's been the trend, like if you look at Walmart, here, I'll just pull up the numbers real quick on Google. So Walmart stock in the last year is up 0.88%. So very, very flat. Walmart stock in the last year. So from last February 7th to this last February 7th, it was at 137.96. Now it's at 139. So basically the same. Target, on the other hand, is down
crushed.
20% in the last year.
Yeah.
So I look at this, and some people might be like, oh, like one's strong and one's weak. I want to buy the strong one. Sure, I guess. Like you could argue that. I'm saying like, I don't know. I think Target and Walmart will be pretty similar, be pretty good like competitors throughout, the next couple decades, whatever. Target's probably going to catch up, to Walmart a little bit. So the fact that Walmart's out-returned, been better than Target the past year or so, I wouldn't mind taking a stab at Target here, betting that it'll eventually catch up kind of with the trends of Walmart. Because to me, looking at Walmart's stock up here, that's basically, near all-time highs, like, that's showing me the market's not that worried about retail sales or stuff like that, So, okay, Target will probably, if we're in an environment where Walmart stock can be at all-time highs, that's not the same environment as like an 08, 07, 08 type recession. Like, I think Target will be fine.
And I think Target can catch up to Walmart. Walmart executed better on groceries, but you got to remember Target is fairly new to the groceries game, and they've only been in it for, I believe, maybe they started grocery 5 years ago or something like that. But it hasn't been a lifelong game for them. And then Walmart owns Sam's Club, so they do have a secondary retail outlet that I think people don't give them credit for that hits their books as well. But I think if you remove the emotion, these companies sell things that we need and we're not going to stop using anytime soon. And so when they sell off like this, I think it's just prime opportunity to trade them or own some good companies at some reasonable prices.
Couldn't agree more. And you, with the Target, you kind of gave that example of a way you could sell puts and then own that stock outright if it gets down to that level.
You could sell covered puts. You could come in and I wouldn't buy the stock up here, but if you just had to own it, you could buy it and then sell covered calls against it. But I would rather you sell covered puts, and then if it gets put to you, you own it. But if it doesn't get put, you just collect that premium.
Got it. Some other interesting names, I guess, kind of similar to Target. You have some of the department stores like the Macy's. And I don't know. I mean, I haven't really checked out the charts as much, but I just know from a purely fundamental standpoint, something kind of going on here where they seem very cheap. You also have who was it? Ryan Cohen just got into Nordstrom, JWN, I believe. See how that stock's been doing.
Let's see.
Looks like might be having some Wi-Fi issues.
I don't know why he'd be in that. That's up near resistance from a technical standpoint.
In Nordstrom, you're saying?
Yeah, JWN. It's up near resistance. You can see resistance around 28. It hit its head 1, 2, 3, 4, 5 times on my chart here. I would not be a fan right there. But here's the thing about stocks like Nordstrom and Macy's that I don't like per se. In this environment where there's some uncertainty, the only thing I'm certain of is that Apple has a base. I'm certain that Google has a base. Amazon has a base. I'm not certain that there's a base of people that have to go out and get new clothes, have to go out and get shoes. That's not something they have to have, but you're not going to let go of your cell phone. You have to have toothpaste, deodorant, ladies wearing makeup. Your kids need diapers. Doesn't matter. They need diapers, right? And so some of these companies have stuff that you need no matter what. And so I'm more of a proponent of buying or investing with those companies versus going after discretionary items, right? You don't necessarily need a purse. You don't necessarily need Gucci or whatever the stuff Nordstrom sells.
Well, I'm sure some people, as we get ready for Valentine's Day, will disagree, say they do need it. But I think any time, right, like from just a purely economic standpoint, when we head toward a recession, when people's, pockets start getting hit, you start looking at, all right, what do people need? What can they not go without?
Exactly.
And it's like, you talk about that demand elasticity, kind of take eggs for a good example. Someone put in the chat. A lot of people have been complaining about the price of eggs, like nonstop. I see on Twitter, this and that, which I get it, right? Trust me, I go to the grocery store too. I buy food too. I don't like paying more for my food, just like I'm sure you guys don't like paying more for your food. But I just want to know, for all these people who complain about the price of eggs, how many eggs are y'all buying? Right? Like, I go to the grocery store, I buy a dozen eggs, and it's still like, all right, it's more expensive, what, $3.5, $4 now instead of like $2? But that's just one dozen. Like, that's all right? I don't need to buy 80 eggs. I'm not buying, granted, it's just me. I don't have like a huge family or anything. But take eggs, for example. Like, there are a lot of things where if the price went up 100% over the year, you would just say, screw that, I'm not buying it. But a lot of people can't do that for eggs. They got to buy the eggs for their family so the kids can eat breakfast.
You're going to buy eggs anyway. You're going to cut your Netflix subscription off before you not eat eggs. And then when you think about eggs, everyone's maybe not Netflix.
No, go ahead. Well, I have my own take on this.
But here's my thought. I think the people who worry about eggs are the same people who worry about when gas goes from $3.50 to $3.60, and they're driving around trying to find that 10 cents. It's like, how many gallons does your car take? 10, 15? So 10 cents, you spent the extra $1.50. Maybe you gas up 4 times in a month, once a week. So it's $6 is going to be the difference between you losing your house, losing your car note, or losing your mind. Probably not. Same thing with eggs. So I don't look at the price of those things and be like, oh my God, the world's going crazy, right? It's like, it's extra $1 for some eggs. Like, it's fine. Just add some milk to it, make it go further.
No, so what I was going to say, and I agree. The thing with the gas always is crazy. There's a gas station up by me on Woodward that has like the cheapest gas in the area by like 10 cents a gallon. And there will be a line so long outside the gas station that's backed up on Woodward. Like, they're blocking off the whole right lane on Woodward to get in this gas station. I'm like, drive a mile up here. Gas is 10 cents more expensive, but you don't have to wait. The time that you're going to spend waiting is worth more than the $1 you're going to save on the gas. And it literally makes like no sense to me. But the managers of that gas station are geniuses, because I'm sure they're selling way more gas than everyone else.
It's the psychology of humans, right?
Yeah.
We value saving 10 cents on something that doesn't take more than 15, 20 gallons, maybe $2, but we don't value our time, which we can never get back. If I can save 30 minutes of my time, trust me, it's worth $2. Yeah. Right? I will pay the extra 10 cents per gallon.
If $30 of your time isn't worth $2, then you need to reassess what you're doing with your life and like figure out, some stuff. Because everyone should feel that their time's worth more than $2 or $4 an hour or whatever it is, because you guys are worth more than that, trust me.
And think about the investor psychology, right? We're willing to stand in line, waste time to save $2. We're not willing to buy Amazon down at $80 and wait a month or two for the rally. Like, that's taking too long. I got to get out. What's going on with these stocks? Or Apple's down here. It's taking too long. And so we have to think about, where are we investing our time, and what are we willing to wait for, and what are we willing to not wait for? We're willing to wait to save $2 on gas. We weren't willing to buy some of these great stocks at 50% off and get a 30-point rally over a month or two.
Yeah, that's a great point. So going back real quick, what I was going to say about Netflix, because I agree that Netflix is in that category of things, you can start cutting once, you start looking at your bank account and realizing, okay. But hear me out. Here's my thesis. Okay, say we are heading to, you have kids, right?
Yeah,
you took them to Florida, whatever, right? How much that cost, ballpark, take your kids to Florida?
It's probably $2,500 between plane tickets and
hotel,
food. Well, we didn't have to stay in the hotel. We stayed with the grandparents.
Oh, perfect.
Yeah,
so
but if it was hotel, it would have been more.
So here's my thing. If we head to a real recession, and there's a bunch of people out there like you with kids, whatever, and you're used to doing stuff like that, taking your kids, whatever, spending money, isn't $15, $20 a month on Netflix a great deal for entertainment? Sit your kids in front of the TV, say, okay, instead of spending, going to Dave & Buster's tonight and spending $300, we're just going to stay at home and watch a movie. You can actually save money by spending $20 on Netflix.
Yes.
Than you could, doing other entertainment with your kids and whatever. I just think from a purely like family standpoint, you can get so much value of just like entertaining your kids and stuff from Netflix that I think in a recession, people might actually like rely, and maybe you probably will still have a lot of people that would cut it, because the $15-$20 a month might make the difference if their kids can eat or not, right? That's gonna be a bigger deal. But I think if people start cutting entertainment costs, Netflix might actually be the last thing they cut, because it's pretty cheap relatively, and a lot of time and entertainment baked into that, versus like how much you'd get. Think about taking your kids to go see a movie at the theater. If you your kids go see it in the theater,
the overpriced popcorn, the overpriced
snacks,
candy,
overpriced ticket, going to the right, versus just throwing a movie on at home on Netflix.
So to that point, now we're talking about like economics, because it's going to hit different income classes differently, first of all. And you're right. Most people are going to say $10, unlimited TV shows to keep the kids entertained. I'd rather keep that and cut somewhere else. And so some stocks have the reverse effect during, inflationary periods or during recession. Amazon, for example, to me, if I'm already paying for this and I get everything delivered to my doorstep, I'm not cutting that. Number one, the prices are cheaper usually. Number two, I can save gas and not leave my house, right? So, and then number three, I get a longer return period. So there's some stocks that actually are better in a recession than during great times, or at least they hold up better, I should say. So yeah, great point with the Netflix. AMC traders, though, you're in trouble if we hit a recession because anybody paying for that overpriced movie theater.
I did the other thing I was gonna say too is to your point, certain things that actually benefit from it. I did just as an experiment. I look back at some of the top performing stocks the last time we went to a true recession. This was back when, I don't know, a couple months ago when it wasn't even like if we're going to recession. It was just like how bad's it going to be? When's it hitting? Because everyone was just saying we're going to recession. It was like a foregone conclusion. Now people are a little bit more torn of if we're going to it. But and this was kind of going back to what I was saying about the Walmart versus Target. But some of the best performing stocks in the recession in 07-08 were like your dollar stores.
Yeah,
your Dollar Tree, Dollar General, and those, if you look at their charts, were like, what's the Dollar Tree?
DLTR.
DLTR. If you look at this chart, let me pull it up real quick, if we can get it to load. Go to the daily chart. Go back to. Are we not loading? Oh, here we go. Go back to 07-08 was like basically at its all-time highs, and obviously nothing else was at the time. Yeah, see here where we are. Oh wait, no, Dollar Tree still came down. Oh, maybe okay. So maybe by August 2008, Dollar Tree had come all the way back to its pre-crash levels, where the rest of the market didn't recover till well into 2009. So a lot of those, some of these companies actually benefited from people, dealing with inflation, see. So the stock market, here's the SPY, didn't get back to its, recover until really, well beyond 2010 even. But Dollar Tree stock came back pretty quick. It got hit with everything else just because economic activity slows down, growth slows down. But from a certain standpoint, in that recession, it was performing better than the overall market.
Yeah, and that's the thing. When recessions hit, sometimes the market is counterintuitive to what you think. You think oh, this is going to crash, that's going to crash. And sometimes what you thought was going to crash didn't crash. What you thought wouldn't do well does well. And I think most people have to think outside the box and start thinking further down the road. And here's the thing. Recession is just this big fear word. I always ask myself, for how long? A recession for how long?
Yeah, because some people think we had a recession last year, right? For those 2 negative GDPs. And it's all right, if you want to call that a recession by the book, sure, be my guest. But you can't say that it felt like a recession or that it felt like the 07-08 recession. You know what I'm saying? So it's even last year, that was kind of like a joke that it's oh my God, we can't even decide on if we're in a recession or not. But I do think that was debatable because, again, you could, by the book, sure, say it technically was. But does that matter if it technically was or not? If it didn't feel like it, if stocks didn't act like it, if people didn't act like it, if flights were still booked and everyone was still going to Vegas and everything, was it really a recession?
So here's my beef with the recession word. And like you said, it didn't feel like one. Here's my beef with that. We had a technical real recession, 2 negative quarters of GDP. They didn't want to call it a recession. Now, GDP is either flat or growing. They're saying the real recession's coming. So I'm like, what was that, the fake recession?
Right.
And are we now going to start basing recessions on how we feel? So just because we had job openings, we're not going to call that one a recession. So I feel like that's unfair to traders because I believe we already had the real recession, which means a floor is already baked in. Its only thing is left for us to stabilize or go higher. And I think the longer they play out the recession story, it scares people from spending money, which is what they want you to do. And when you don't spend money, then they can say we had a soft landing. So I think there's a media spin to this whole recession thing. But we had a real recession. No one wanted to call it that. And then they scare you by saying the real one's coming. Yeah. Well, what is the real one? What does that look like?
And that's why I've talked about this on the show before, too, is I get worried about, what if everything is I'm not saying everything's great right now, but I'm saying what if everything's okay, economically from a macro standpoint, But just because everyone's like worried about this recession and companies start planning for it and they're saying, okay, we're gonna, start cutting costs and not worried as much on growth as we like prepare for this, it's almost like self-fulfilling prophecy, right? Everyone's like getting ready for slowing growth, gonna cause the slowing growth.
Exactly.
I don't know. It just seems weird. But real quick update, because I see some people in the chat asking about Powell. Jerome Powell will begin talking in about 9 minutes. We are working on getting, a live stream set up. Although, because it's not an actual FOMC stream, I'm not sure if we'll have like the full stream. But at the very least, we'll be doing live commentary on what he's saying. We will have a stream of, at least like his audio and whatnot. So.
I'm seeing people in the chat say, yeah, they keep changing the definition of a recession.
Well, that's the thing that's like, because everyone was said, okay, like the textbook definition was 2 negative quarters, but then it was like, okay, like, is there one econ textbook that decides this? Because there were like other econ textbooks that said 2 negative, quarters of like more than, because I do think it makes it, because if you said 2 negative, but each quarter was down 0.01%, it's like, okay, like it's pretty flat, right, for all intents and purposes. You should have maybe a different word for like very, very small, slower growth that's not recession. Like recession carries like kind of a weight to it.
Like
right?
The world is over. What are we gonna do?
It's a recession. Like it's a recession. No, I can't do that. It's a recession. I can't do that. The GDP is down 0.01%. So also I did see because I saw that you and someone else was talking about Disney. Just going to Disney in the chat. That is honestly something that I don't understand. I'm very grateful and blessed to have like come from a pretty well-to-do family. We never did Disney World or Disneyland growing up, but like I haven't really looked into it because I don't have kids or anything. But from what I know, from what I hear, like no, like that is not happening. I would never do that. And that's as someone again who like is blessed to have come from like a well-to-do family and good background and everything. That like even I just wouldn't be willing to spend like that thousands and thousands of dollars on like 1 week or one weekend.
Wait till you have kids.
But okay, and I get it because like they would want to do it, but it's like couldn't you also just have like a way better, almost do more stuff for like cheaper, like a different vacation?
It's all about experiences. I think once you realize we can't take the money with us, I think a lot of people realized through COVID that you're never really guaranteed tomorrow. I think a lot of people are like, let's just go for it, right? They're watching Frozen on TV. They're caught up in all these characters. So I think it's an emotional thing. Just like, I look at my watch. Some people are like, I would never pay that much for a watch. And then some people collect guns. I'm like, I would never pay that much for that type of a gun. Like everybody has their thing, I think. But experiences are something that it's hard to rationalize with somebody. I mean, we probably both didn't buy the $9,000 Beyonce tickets, right? But some people are like,
I didn't get
Beyonce
on the wait list.
live in concert, they're like, gotta go, gotta be there. And that's only gonna be like an hour long. At least Disneyland is like a week.
Yeah, and I think too, like you said, I've never been, like I said, so like there might be a day where I have kids where I'm like, shit, I've never been, they've never been, let's do it. But the money thing aside, it's just like I look at from like pictures, videos, it just seems so. It's like maybe I'd rather go like spend half it and go to just like have a nice like beach house for the week, more like relax, or like go like skiing or something. You know what I'm saying? Like I don't know if I feel like it's just almost. I'd be worried like doing it essentially just to do it to say we went to it, and not that I would be getting my like thousands and thousands of dollars of worth, if that makes sense. You know what I'm saying?
That totally makes sense. Yeah, and in that case, you definitely shouldn't go to Disneyland. But if you're going because you're like, this is an experience, my kids grew up watching this, it's like we have to go. Or you grew up watching Michael Jordan, then when he did his last basketball tour, you pay whatever for those tickets because you're like, I just gotta be there. And that's where emotion comes into play.
Yeah, and I mean, that's what Disney does a great job of. I mean, they create that, like, storyline narrative. I think people really, like, truly feel, like, kind of like a magical feeling when they think of Disney and all this, and it's, like, incredible that they're able to create a brand, right? It's not the rides, it's not, the actual location or the hotel rooms, right? It's, like, the characters, the things, and that's what they're able to charge this crazy upcharge for, and, like, you got to give them credit for that, right? You got to give them credit for the fact that there are people that are willing to pay like these crazy, sums of money to go just for a few days to give that experience, because it is, I think, for the people that, are big Disney fans or take their kids to Disney would tell me or someone who hasn't gone, like, you just don't get it till you go. Like once you know, whatever, like, or you see your kids there or whatever, then you really like understand where the value is.
And when you bring that back to the stock market, it goes back to what we initially started talking about. They still have a core business. They still have a core business and a core collection, a core library of content that will always resonate with kids, and they keep creating, which you can feel confident that the stock price is not going to zero. So when it's down in the 80s, it's like, I might want to own some of this.
Yep. And again, I missed it at 80 twice. I'm gonna try not to miss it the third time. All right, let's see real quick in the chat if we've got any other stocks people would like to check out, etc. Because we've only got about a few minutes left here. Anything else top of your mind, Jason, that we haven't gotten to?
Let's see here. I got the charts up. Well, I noticed that chip stocks have been rallying lately, which I thought was pretty interesting, because if there's a slowing, corporate spending, they're not necessarily ordering computers. I thought it was interesting that chips are off the bottom. You look at AMD, you look at Intel, that's off the bottom, NVIDIA. And the only thing that, I know NVIDIA makes different chips from the other two, but I'm having a hard time wrapping my head around the rally in those chips. But I mean, again, NVIDIA was down to about $122 or $108. Now it's at $215. Some of this stuff you just have to look at and say, it's not going to zero. It's not going to zero. We need chips. They're putting them in cars. They're putting them in the servers. You have Chat GTP or GPT now that's getting all exciting, all this AI stuff. All of this stuff is powered by computers and chips. So I think it's a sector that you never really want to count out, because we'll always need chips for something.
Yeah, and NVIDIA is like one of my favorite stocks, if not my favorite stock, and it's been that way for a long time for kind of that reason, as I think like NVIDIA, what they're focusing on, its technology and its chips, is literally going to be in like not every single piece of technology in the future, but if you think about all the different types of technology that we're like heading toward, whether it's self-driving, AI, robotics, gaming, crypto, cloud, right? NVIDIA's in like all of those things, and you need semiconductors and all of those things, and it's like, all right, like if I know all those things are about to grow, like why not get a company that has exposure to all of those things? But it's obviously never that like simple, and NVIDIA, as someone who loves the stock, as someone who owns the stock, I worry right here. I mean, we're up like 100% in the last like month or so, like a couple months.
But
like,
from a technical standpoint, it looks like a nice cup and handle, and that typically means we could continue higher.
Yeah, I mean, looking at the chart here, just my quick. I don't even do like TA that much, but it looks like you could kind of keep filling this gap up to the upside here, at least to like 290 until you hit this spot right here. Exactly. But again, I think anytime, like my whole thing is like, I think from just a purely, look, so we were down at 105 in October, so that's 4 months. But even just from here, from 140 to 215 in like a month, that's a huge
monster
run.
move.
And I always just worry about, and we both could be right? Like we could pull back 5% from here, but then keep moving back up here. I just think always thinking when you have that big of a move in the short term, like you can be, there can be people out there looking to take some profits, people looking out there to just take their money and run, or like you said earlier, to get their soldiers back home, live to fight another day, and then find a different war to go fight.
Absolutely. Well, I mean, the NVIDIA could turn out to be like Boeing. Boeing had the same setup. You'll see that cup, a little bit of a pullback, and then it just kept going. But now, I mean, it's up near resistance. But what's important, though, is I think that traders and investors think about time frame, too, right? If we're talking about buying NVIDIA or something now, it could pull back. But if we're talking about 12 months from now, 24 months from now, you're right. It could be up near 280. It could be up near 340. So it's also important to keep time frame in perspective. As a trader, I look super short term, so I wouldn't be buying after a 71-point rally because I'm not investing per se. And if you're trading, you want to buy off a pullback or at support and sell at resistance. And right now, that's looking like resistance for short term until it tells us otherwise.
Got it. All right, well, it is 12:40, Jason, so we've got our man JP starting to speak. I've got a live stream pulled up. I'm going to try to share it, but I'm having some some issues doing so right now, so we'll see if I'm able to. Let's see.
Well, while you're pulling up, JP, I appreciate you guys having me. It's always fun to hang out
Yeah,
with the Benzinga crew and talk stocks.
Of course. Hold on. Are you getting that? Are you getting that other audio now too? Where can folks find more from you?
Just check me out at The Brown Report. I'm The Brown Report on YouTube or thebrownreport.com on all platforms.
The Brown Report. Sorry, are you getting that audio too?
Mm-hmm.
I heard that we got two things going on at once now. Thebrownreport.com, you said?
Yes, sir.
Thebrownreport.com. There we go. Got that in the chat. All right, Jason. Well, dude, it's always good to have you in the office. Always good to get fellow Detroiters, fellow Michiganders in here, man. Talk
it's
about
nice
the market.
to do this in person.
Yeah. Let me know next time you're downtown for anything. We'll just have you pop back in.
For sure, Aaron. Appreciate you, brother.
Yeah, of course. I'll be on for another like 15 minutes or so. I don't know if you're gonna be hanging out or not, but if not, I'll catch you around.
All right.
Alrighty, y'all. That was my man Jason Brown coming in downtown, hanging out with us live and in person. Before, let's see, is this my? Oh, there we go. There's my man JP.
About to be
All right,
subsequently.
here we go.
Had you known
This is go
that
time.
the jobs report was going to be as strong,
Oh, you got for a few.
would you have done 25 basis points
Oh,
or something different?
David, thank you for that question, and thank you.
All right,
Thank you
so
for
far
inviting me
Powell
here
seems to be
today. It's
in
great to
pretty
be here.
light.
So we don't get to
mood,
play it that way,
laughing,
unfortunately.
jovial.
We
Good
have
to see that.
But I'll take it this way. So the message we were sending at the FOMC meeting last Wednesday was really that the disinflationary process, the process of getting inflation down, has begun, and it's begun in the goods sector, which is
All right, so
about
it's
a quarter
acknowledging
of our
inflation's coming down.
But it has a long way to go. These are the very early.
Okay, you just said it has a
stages
long way to
of
go, though.
disinflation.
So the first part was
So the
dovish.
services
Now
sector
it was a little bit
really, except
hawkish.
for housing services.
We'll see how the SPY's
It's
reacting.
not really showing any disinflation yet. So our message really was this process is likely to take quite a bit of time. It's not going to be, we don't think, smooth. It's probably going to be bumpy. And so we think that we're going to need to do further rate increases, as we said, and we think that we'll need to hold policy at a restrictive level for a period of time. Then comes the labor market report for January. And it's very strong. It's certainly stronger than anyone I know expected.
All right, so
And
SPY's
so-
going
but I
up
would
right
say
now.
We didn't expect it to be this strong, but I would say it kind of shows you why. we
Okay,
think
so I said that
this
too,
will
that the
be
Fed was going to say that they
process that
didn't
takes a
expect the
significant period of
market.
time.
Powell said that
Labor
himself. He
market's
thought that the
extraordinarily strong.
Well,
And by
there
the
we
way,
go.
it's good. It's a good thing that inflation has started to come down without it. That has not happened at the cost of a strong labor market. So, and of course, since then, financial conditions have tightened significantly since then.
So let me ask it another way. So, by the way, when the numbers coming out, the jobs numbers, 519,000 jobs, does anybody call you up in the government and give you a little heads up this is going to happen, or they never do that?
So on some data, sometimes we get data just the night before, and it's only me, and
Okay.
but not on all pieces of data. It's a very small.
Why would they give it
amount
to
of data. We
just
get
the-
it
just
the
to
night
him?
before.
That
For
doesn't seem-
example, if we were going to get a big piece of data in the middle of an
That doesn't
FOMC
seem to make
meeting,
sense.
as often happens on the day of an FOMC meeting, it will help me to know it the night before.
Okay, so the markets,
All right.
after your speech
Let's see.
last week, the markets assumed
SPY,
that
oh my God,
there
we're
would
ripping.
probably
Up
be
half a
another
percent
25
now.
basis point increase
So
in
basically,
the
all Powell's really
next
said so far is
FOMC meeting.
we've been surprised the labor market's been able to been so strong, and that the
Again, what we said at the meeting
inflation
was,
has started to come down. But like he said, it also has a ways to go.
we believe that we anticipate, is what we said, that ongoing rate increases will be appropriate. And the reason is we're
Uh-oh.
trying to
All right, market
achieve
might come down off that
policy
right there.
that is sufficiently restrictive to bring inflation down to 2% over time. And we don't think we've achieved that yet.
Okay, so
we
more
said
rate
that.
hikes.
And
I'd be
you know,
surprised if the market
now
doesn't
you
come
see
down
the
a little
labor
bit off
market
that.
report, and I think, again, financial conditions are,
Oh, and it just went up.
more well aligned with that than they were before.
So the assumption when you made your speech was that probably the Fed might even consider decreasing rates by the end of this year, and the markets no longer assume that. Do you think the markets are wrong?
Well, so let me say, these are, all of these numbers that we're throwing around here are conditional on incoming data and what happens. So We never say this is what we think will happen.
Data
we
dependent?
make a tentative forecast, and then we let the data come in. For example, if the data were to continue to come in stronger than we expect, and we were to conclude that we needed to raise rates more than is priced into the markets or than we wrote down at our last group of forecasts in December, then we would certainly do that. We would certainly raise rates more.
Okay, so today, for people who aren't familiar with the FOMC, who actually is on the FOMC?
So the U.S. Central Bank consists of a board of governors here in Washington. There are 7 governors. Those governors are nominated by the president and confirmed by the Senate, and we serve terms that are not synced up with the election cycle. So we're independent. There are also 12 reserve banks around the country which have a degree of independence, and so each reserve bank is led by a president who works there full time. All 12 of them sit on the FOMC, so that's 19 people sit on the FOMC. So it's quite a large committee, of which 12 vote in any given year. The Reserve Bank presidents vote on a rotating basis, except New York, which votes every year.
So when you vote, do you vote at the beginning of an FOMC meeting and then just kind of have discussions afterwards, or do you wait to the very end and then you vote?
No, we vote at the end. I mean, the FOMC meeting process takes, more than a full week. I'm talking to all of the participants, all 18 other ones, and staff has sent around memos, and there's something called the Teal Book, which is the staff's assessment of the, of the economy and international economy and monetary policy and all that.
Okay, so
we have an extensive discussion on the morning of the first day about the economy. Everybody talks about that. On the second day, we talk about monetary policy, and then we vote on monetary policy at around noon on the second day.
So does the chairman of the Federal Reserve Board speak first and say, here's what I think, or does he wait until the end and say, well, thanks for what you think, but let me tell you what I think? What do you do, first or last?
Different chairs have done it different ways, and so I've tended to do what my immediate predecessor did, I think. Well, this is what I do. I speak last on the sort of the economic go-around, so everyone else talks about what they think about the economy and in their district.
Congrats,
Jay,
Ggatch. I think Ggatch just sold my QQQ calls. Cha-ching, done for the day. So we bounced 50% retracement. Yeah, I don't.
Okay, so
I wouldn't be.
2%.
I didn't have any trades going into this, but I don't think I'd be getting long here, just because I don't think.
Could be tolerable, really. I mean,
I just don't think he's going to say anything like.
3% is considered okay. Why do you want 2%?
So 2% is the global standard, and that is our objective. 2% as measured by the PCE index, and that's not something we're looking at changing. That isn't going to change.
That's not going to change.
Not going to change, no.
But okay, so you need to get the 2%, and your goal to get there is by what period of time would you like to get there?
Well, we say that we're using our tools to get there over time. If you look at our forecasts, we expect 2023 to be a year of significant declines in inflation, and it's actually our job to make sure that that's the case.
Okay, significant decline in inflation in 2023, Powell expects, he just said.
Headline.
I do think, by the way, I do think this stream is about a minute or so behind, because I got an update from our news desk that Powell said that about 30 seconds before he said it on my stream. Thank you, Bill.
Next year to get down close to 2%.
Okay, so 2% is firm. You're not going to get off that.
Yes.
Okay, that is a big key thing, because a lot of economists thought that the Fed might move the inflation target a little bit, say like, okay, 3% year over year, that's good enough. We can start cutting now to start focusing on growth again.
What's wrong with the theory? Why is unemployment not going higher?
Well, the labor market is strong because the economy is strong. And as I mentioned, it's a good thing that we've been able to see the beginnings of disinflation without seeing the labor market weaken. It's just that there's a lot of demand for workers. In fact, if you look at the supply of workers versus demand for workers, demand for U.S. workers is now more than 5 million greater than the available supply. And the available supply consists of people who are either working or actively looking for a job. So this was not the case before the pandemic. The pandemic really had a left a lasting mark so far on labor supply in the United States. The labor force participation rate came down, and there now is a shortage of workers, and it almost feels more structural than cyclical. So that's a significant issue.
Now, you've resisted, I think, saying what unemployment rate would be acceptable to you, I think. But is there an unemployment rate that you think would moderate inflation such that you would tolerate unemployment at 4%, 5%, 6%?
I guess I think about it this way. You know, we have
That was a
two
dumb
goals
question.
that Congress has assigned us: maximum employment and price stability.
They have a
Price
dual
stability,
mandate.
as we
Yeah.
agree,
Okay.
is
I'll let
2%
Powell
inflation.
answer it. That was a dumb
Maximum
question. I'll
employment
tell you why
means
later.
If you want a job, you can get
What do you
one.
think? Do you think he's going to
So
say,
right
yeah,
now,
we're
the
okay
labor
with
market is
6%
at least
unemployment?
at
No.
maximum employment. But many would
So
say
it's about
that
balancing
out
the-
of balance with more demand
see,
than there is
thank you.
supply. So what we're trying to do is get inflation down. We're not targeting you know, a different unemployment rate.
He just asked if we were going to target like a
use our tools to
5.5%
get
unemployment. That was a
inflation to come
dumb
down over time.
question.
In hindsight, would you say that when COVID hit the economy and we injected $5 trillion of fiscal policy into the economy?
All right, we'll take a
the
break
Fed
from
did,
Powell for 1 second. I see our
quantitative
last
easing
guest of the
and
day
others
hanging out
related things kept
backstage.
interest rates very low. Would you say in hindsight that was a mistake or was the right policy at the
Without
time?
further ado, hold on, give
I
me a
think you have to
second.
go back to the decisions that were made in real time, and it was something nobody had ever seen. The global economy came to a virtual standstill. People were talking about depression. People were talking, and we didn't think we had no idea when we would get vaccines that worked. So Congress took very strong measures, and we took very strong measures. And you see where the economy is. You've got a very, very strong labor market, but you have high inflation. As I mentioned, we're at the beginning of getting that down. If you look around the world, though, at other countries, they're also experiencing high inflation, including countries that didn't do as much as we did, either from a fiscal or monetary standpoint. So that tells you, though, that a big part of this inflation is actually related to the pandemic itself, the shutdown and then the reopening. That's a big part of it.
Now, the quantitative easing program has increased the balance sheet, I guess, of the Fed. And what is your balance sheet now?
I think it's $8.4 trillion.
You must sound like you know. Sounds 8.4 trillion.
That was yesterday's number.
Okay, all right, 8.4 trillion. What would you like it to get down to over the next year or two? Is there some lower number?
So we are in the process of shrinking the balance sheet actively, actually passively, I should say. So what happens is as Treasury securities on our balance sheet mature up to a cap, a monthly cap, the balance sheet shrinks in that amount. Same thing with mortgage-backed securities as they are prepaid or so the balance sheet is shrinking. In terms of the target level of it, we haven't put a specific dollar number on it. The idea is we're in a regime of ample reserves. Reserves are basically deposits at the reserve banks. And when we get close to that level where we feel that reserves are ample, kind of where we were before the pandemic, then we'll slow down and we'll sort of test where we are. But it'll be a couple of years, we think, till we get to that level.
The Fed does not sell securities. They waits for them to mature, and then you just cash them in, right? You're not in the market selling securities that are not yet mature. Is that correct?
That is correct. It's also correct, though, that we've said we would consider sales of mortgage-backed securities, but I will tell you that's not something that is on the list of active things being actively considered.
So some people are worried about the federal debt limit, and if we might not be able to extend it on time. We have $31.4 trillion of debt. Are you a little worried about the debt limit not getting extended?
So the debt limit is really something for the fiscal authorities to deal with. The Fed, our only role in this is that we're the fiscal agent of the Treasury Department. We're not a policymaker on that. And I will just say this. This really can only end one way, and that is with Congress raising the debt ceiling in a timely fashion so that the U.S. can pay all of its bills when and as due. That's what has to happen. And if that doesn't happen, no one should think that the Fed has the ability to shield the financial markets or the economy from the consequences of moving too slow.
So you don't have any program in place ready to go if, in fact, the debt limit isn't passed in time?
This is something that Congress has to deal with.
And the so-called trillion-dollar gold coin solution is not one you're in favor of, I guess.
As I said, this ends in only one way,
okay.
And that way is Congress voting to raise the debt ceiling so that the U.S. can pay all of our bills.
Okay. In terms of consultation, do you consult regularly with the Treasury Secretary or the head of the National Economic Council or the President of the United States? How do you kind of relate to the administration?
For a long, long time, 60 or 70 years, I think there's been a weekly breakfast or lunch with the Treasury Secretary and the Fed chair. And that's what I've had with Treasury Secretaries that I've had as Fed chair. I've also had regular, or call it irregular lunches with the head of the NEC. We also have regularly scheduled lunches with the Council of Economic Advisors. And that's really that's the institutional structure of our contacts with the administration.
So in the way the Fed works today, if you could reconstruct the operations of the Fed, would you change the legislation anyway? Would you think the Fed operates in a way that's as efficient as you can realistically operate?
We're not looking for any changes to the Federal Reserve Act. I mean, I think it does work. The structure that I discussed earlier, where you've got the 12 Reserve Bank presidents coming in, what that assures, really, it institutionalizes diversity of thought. So we get different people coming in who've got different backgrounds, different careers, and they think different ways, and I think that's enormously beneficial to our decision-making process.
So there has been discussion recently about the Fed, some Fed members, Fed board presidents, selling their securities and maybe not doing everything they were supposed to do in terms of disclosing it. What have you done to fix that process?
We put a new system and a new set of rules in place, which I think are best in class for a public institution like the Fed. And the innovations were that if someone wants to sell something that they own or buy something, they have to clear that in advance with staff at the Board of Governors, and then you've got to wait 45 days for that to execute. Also, you can't own individual stocks, and you can only authorize these transactions or execute them during specific times. And we disclose, of course, all of these are disclosed. If your idea is to trade things, buy and sell them because you think this stock is cheap and that kind of thing, that's just not something that will work.
So what is the salary of the chairman of the Federal Reserve Board?
It's around $190,000, I believe.
Okay, so you live on the $190,000. If you need to sell something, what do? You have to clear it for 45 days, or?
That's right. We have family expenses that, if we have them, that exceed my salary, then we have to sell an asset.
You think that's a fair salary for the job, or?
I do, yes.
You do. Okay. So today, how do you coordinate with central banks, let's say in England or Japan or China? Do you have regular conversations with them about what they're doing?
I mean, in terms of people that are like way overpaid in America, I don't think you could throw Powell up. He's literally like in charge of the economy. He's getting less than $200,000 a year. I mean, there are freaking CEOs of like failing companies that get paid 20
among
times
major
that.
central banks, I have regular dialogues going with most of them, and so what we're talking though about is
He doesn't
really
need
what's
anymore. I mean,
happening
Powell came from like a
in the
long
economy and how we're
career
thinking
in
about
investment
policy.
banking. I think he has like
It's
multi
very important
millions of
that we
dollars.
keep
He's
those
not worried about
discussions
money. I'm
going
just saying
because
from a purely like
particularly in a crisis, you're going to need
salary
to know each other.
standpoint. I mean, the president only gets paid like
Trust each
gets
other.
paid like
Do you think
$400,000
the
or
U.S.
something.
economy is pretty much in control of its own inflation rate, or are there events outside the United States like what China is doing or the Ukraine war that are affecting inflation and make you nervous about where inflation might be going?
We have the tools, the Fed has the tools to achieve our 2% goal over time. But inflation in the United States is, of course, very closely related to things that happen here, including the balance between supply and demand. It's also affected by, for example, commodity prices that are really set on the global markets. Oil and many agricultural commodities are priced globally. So there are certainly, it's an integrated global economy and global markets, and we are part of that.
So you get data from all the various government agencies, but do you ever use anecdotal things like you go to the supermarket and you see prices are high and you say this price is high, or how do you ever get anecdotal things, or people ever call you up or friends and say, by the way, you should do this or that? Do you ever get that kind of information, or do you only get it from the government reports?
I mostly get data, but I will say I do believe that anecdotal information is very useful, and one of the things the reserve banks are great at is all 12 of them have big operations where they talk to businesses and nonprofits, universities, every sector of the country and the economy, and they bring that back to the FOMC meetings and they talk about what they're seeing, because often, staring at data is great, but you need to have a story, and I think hearing the stories that people tell, it does help me to sort of, assess what's going on out there.
So as the chairman of the Federal Reserve is obviously an important job. How do you reduce the stress level you have? I mean, you can't be watching economic numbers all the time. So what do you do to relieve the stress other than interviews like this?
The usual things. I read pretty light fiction, detective and spy fiction. I exercise as much as I can. As you know, I like to ride my bike. I
that-
play the
is that
guitar,
safe?
play music.
Wait a second, is that safe, riding a bike, dangerous? And
It's safe. It's safe if you stay on the bike, and
okay. You're good at that.
that's what I try to
And
do.
you still play the guitar, or you're still...
I do, yeah.
Your hair is awfully short for playing the guitar. Don't you need longer hair?
I didn't know that.
Was your hair
It's the first
longer
thing I've
when you
learned
were
today
younger?
Right,
so
it's
far in
too
the,
great,
in the
Okay.
conference is that
So let
Jerome
me
Powell
ask
plays
you,
guitar.
about the
Alrighty,
issue
y'all.
of,
It is 1
what
p.m.
it's like to be chairman of the Fed. You can't go have regular friendship kind of dinners or meetings, can you, with people? People treat you much differently, I assume, than they used to, right? When you go to a restaurant, are people listening to what you're saying or something like that?
I have always thought that my jokes were funny, David. But no, so yes, it's. I've never been a public figure before like this, and it's very different. But it's a great honor to serve. But yeah, when you go in public places, you have to be very careful about.
And
what you
does
do.
the President of the United States ever call you with any advice, or you don't realize did President Trump ever call you, or President Biden ever call you, or?
Well, I think it's a matter of public record that President Trump did used to call me from time to time.
Okay. What did he call you?
No, I haven't had that kind of. I haven't gotten any calls from President Biden.
Okay, so the biggest challenge you have now is being able to keep a straight face, not telling people what you're going to do in the future, and look at the data and then come up with the right solution, right? That's mostly it.
I think the biggest challenge we face at the Fed is completing the process of getting inflation down to 2%. And what I want to point out is that we're seeing disinflation in the goods sector. We expect to see it in the housing services sector, and these are the three parts of the core PCE inflation index that we look at. There's 56% of the economy, which is the rest of the services sector. It's the biggest part, obviously. And we're not seeing disinflation there yet. And that's going to take some time. And we need to be patient. And we think we're going to need to keep rates at a restrictive level for a period of time before that comes down.
So when you made your speech the other day, when you talked about the Fed discount rate, you used the word disinflation 11 times. Not that I'm counting.
Alrighty, y'all. It is 1:03
So you were
p.m.
saying
Time
that
to get over to
disinflation
stock
is
market
beginning to
movers. Thanks for hanging out
Would
with
you
us
use that
today. I'm
word
sure Mitch will be
11 times
monitoring
again
this as
today
well
if
if you
there's
want to
a
keep
jobs
watching
report, or
Powell.
would you
Stick
not
around
use
with
that
us.
word so much?
Without further ado, we'll be
I
back
might
tomorrow
use the-
morning,
I
11:30
might say-
a.m. Eastern.
I
As
would
always,
certainly
till
use the word
then,
disinflation. Yes,
stay
which means
green.
declining
Let's do a
inflation,
quick
and
final
I
check on the
call
S&P
declining
500, see how we look in.
And today, what about the debt, total debt of the United
Still
States?
moving higher.
Produces some inflation, 31.4, leaving aside the debt limit.
Q's
Are you worried
up
about
now,
the
1
total
point.
debt
Oh,
of
coming
the
down a
United
little bit.
States producing inflation? or
Thank
do
you,
think that's
guys.
a big problem?
Smash the like if
It's
you
not
have
the
not
level
already.
of debt. I would say the thing I'd say about the level of debt is really.
We'll be back tomorrow.
Well, it's not the
Stay
best
green.
job, but I would
Peace
say
and
that
love.
we